my knowing Toby and how important it's been to my trading. I thank everyone. I see still folks logging in. Awesome. Just out of curiosity, how many of you have ever thought about how to optimize your trading, the business of trading, right? That phrase, the business of trading, I learned from Toby and Anderson. Yeah. How many of you have thought about that? Of course you have, Daryl. Of course. Okay. A couple of you have. All right. Excellent. Toby's going to talk about a lot of things. I'm going to talk about Toby. All right. So why are you here? And hopefully what you will get out of this time here together. Watch some of the videos. Oh, excellent. Excellent. All right. Excellent. That's how I was introduced to Anderson. So let me give you a little background here. And I know Bot's got, and this is being recorded. It's good that it's being recorded. It's even better that you're here live because Toby's going to drop some serious knowledge on you. If you haven't already grabbed pen and paper, and those of you that are already members of Anderson, Todd, that's awesome. You know you're about to get a full-on education. So let me give you a little background here. It's been since 1997, so it's been a minute, maybe 96. I forget, it's been that long that I was first introduced to Anderson Advisors, and it was in a business capacity where I'd gone to a seminar and I was learning more about smart business, running a business in a smart way, in a tax-wise, also asset protection way. So this is not just about protecting your assets. It's not just about smart tax approaches to what you're doing as a trader or really a business person. It's about putting it all together. And it blew my mind. It absolutely blew my mind. Everyone was still doing the old way, trader tax status, things like that. And that, frankly, is not a good way to go. Right. So I started learning more about the way that Anderson has taught me to structure my business of trading. All right. So the main thing I want to get across to everybody, if you've never thought about it before, this is a great problem to have. My favorite thing is when someone raises their hand in the Sector Secrets Mastery and says, hey, Rog, who handles your tax stuff? Because that means you're making money. Now, whatever money you've made, how hard it is you've worked, the investments you've made in your education, all these have implications to running a smart trading business. I am not the expert here. I can only tell you that it's absolutely been a needle mover for me. Toby is here probably once a year. And that's because every year there's something new to deal with. So I'm telling you, not just as someone here at Simpler, but someone who has been working with Anderson for many, many, many years. And I've known Toby for probably 2 decades now. So yeah, I see a lot of, okay, that's awesome. So, hey, Bot, I don't want to chat away the whole time. Just want to make sure that Toby is ready. And when he is, I will get out of the way. And, but I did want to mention something else before we get started. And I mentioned pen and paper. I mentioned the structuring your business. One of the other things that really did impress me in terms of Anderson is that they take care of everything. One of the questions I get is, Rog, who does your bookkeeping and who handles your entities and who makes sure everything gets paid on time? I pay quarterly taxes. They do, right? I don't have to worry about staying in any way compliant with what I have to do because they handle it for me. And that frees me up to focus on trading. The business of trading is a whole other thing. And that's, again, dealing with the wonderful problem of profits, right? But also when I'm having to worry about those kinds of things, I'm not trading as well as I need to. And so that's, I think, another thing that's really, really important with the time you're spending here. So I think Toby's just about logged in. And again, I am not the expert here, but if anybody has any questions for me in terms of, why I've chosen, and Todd, yeah, I love that you're a member of Anderson. There's a lot of folks. Lorna Bot is, I am, I'm a big fan. In fact, I don't know if you can see the giant bookcase, and it's probably just out of view. But one of the courses I bought from Anderson many, many moons ago was trading as a business. And if there's anything that I hope that everyone is thinking about as they're going to listen to Toby, and I think Bot's still trying to get him in the room. It's giving him a hard time. He is a persistent guy. He will be here. He will be here. One of the things that I know is trading as a business not only applies to the way we want to be as traders, disciplined, working our checklist and sequential in our setups, but on the flip side of it, we have to be that way as well when it comes to the way in which we structure our entities. So that's really it. I aspire to be a client once I'm consistently profitable. I'll tell you what, gang, it's not just about the tax implications. Like I said, it's also about asset protection. And that's another thing that is really important. And of course, this will be recorded. And let's see here. I'm going to check with Lorna about. All right. Okay, so yeah, Toby's still trying to get in. You know what? Let's do this. Since everyone's here and we're still getting folks logging in, yes, Toby will definitely be here. I was just sharing some of my experiences actually being an Anderson Advisors client, how much it's freed me up to just focus on what I do best, which is trading and frankly teaching. And I let the experts handle everything else. But since we're here together and I think we have a little tech issue in the background for Toby, but he will be here. How's everyone doing so far in 2024? And we are in webinar mode, so I can see your questions and I'll read them aloud. So if you have a question, we are in webinar mode just for Toby not to be inundated by the community. I mean, we have a huge community here and we wanted Toby not to be inundated by too much all at once. So we are in webinar mode. Yes. Had a good month. Yes, absolutely. This will be recorded. So you haven't missed anything if you just logged in. As of yesterday, fantastic, says Tom. Right. So the minute I start my year, I'm already thinking about, okay, what is it that I'm going to take as a class, a course? What indicators am I working on? What are the charting platforms and analysis software that I'm buying? Because there are things that I buy. Things like TradesViz are things that I buy so I can monitor my profit and my loss and my win rates and all the nuances around my trading. Those are costs related to trading. And when you structure your trading life again as a business, that's where it makes a lot of sense to, well, you're really reinvesting back in yourself. So as of yesterday, fantastic. Great for 2024. Today was difficult, right? Jerome Powell basically said what we all know has been coming, which is we may not get cuts in March. And we saw the way the markets reacted. Yes, I will tell you this. I don't think this upends the dovish pivot at all. And I'm just keeping an eye on Lornabot here. They are working on Toby getting in here. It will absolutely be worth the wait. I hope everyone's, again, got pencil, paper, and ready to learn a lot. The other thing that I wanted to mention is Anderson is a full service. Well, to me, it's a full service handling my business firm. So Toby is going to walk you through a lot of the implications and the whys and the whats, the things that I know work for me in the trading business side of things. But remember, there's a lot of personnel that take care of you. And I've got a team, just so you know, I've got a team at Anderson of 4 people, right, that help me that guide me through all the intricacies of what it is, a lot of what you'll learn here. All right, so Daryl's working on it. Okay, excellent. Yeah, so the different things that you buy to be, it could be a class. It could be, those of you that have, for example, the PMRs, the HPMRs, DPMRs, you're paying for one of the masteries, you're in the Simpler Central room, right? Whatever it may be. Yeah, these are investments you're making in your trading life, right? I use Pete, I use a service called TradesViz. In fact, how many of you are in the Simpler Central room that are logged in right now? Got almost 200 of us in here. How many of you are in the Simpler Central room? Okay. Next week, I'm going to walk you through what I did in January. It was a good month. And why I am so grateful that Anderson's going to be handling the tax side of that implication, right? When you have profits, you're thinking to yourself, I want to keep as much of this as possible, right? So I'm immediately thinking about an Anderson when the P&L starts going higher. I'll be showing you all my TradesViz. If you're in the Sector Secrets Mastery, I'll definitely be showing it to you on by Monday. And when I see you all in the Simpler Central room on Tuesday, we'll walk through all the trades that I alerted, whether that be in the central room or the Sector Secrets Mastery. I see Toby's logged in. Yes, maybe no. I'm happy to shut up now. There he is. There is the man. I see him there. I'm going to cut out, but he's here. All right. So yeah, we'll definitely talk about that. Gang, it is absolutely my pleasure. And there he is to introduce my dear friend, Toby. It is rare that I can find someone who I like as a human as much as he is just 2 feet taller and 2 feet smarter than anyone I ever know. Toby, you're 8 feet tall. Take it away, my friend. So great to see you. I'm stoked.
All right, I'm going to see if I can share my screen.
Just from the emails that I've been getting from Anderson. So I'm going to take notes here.
Raghee, hang on just for a second. I want to make sure I don't break this thing right from the get-go. Hold on just for a second. We were having a few computer issues, so I wanted to make sure that I got it squared away. So there goes Raghee. Hey guys, so sorry for the little snafu. I'm going to see if I can share my screen, and I'm just going to share out my presentation. Let me know if you can see the presentation. If you could just give me I don't know if you can give a thumbs up, or if you can just put in chat. Yeah, you can see it. Yep. All right, perfect. Then I'm going to dive into this, and we're going to have some fun today. You're going to be talking a lot about tax and a bunch of other stuff. So, we don't have to worry so much about the tech. All right. So Raghee, I've known for flipping decades. And so I could hear her in the background when I was trying to get connected. But just have the biggest accolades now that I could say for her, just because she's been such a great person. Love with the way she treats her family, her mom, and she's just a really cool person. And so I'm really thankful that I get to work with her. And over the years, we've done a lot of things together. You guys don't realize our total history. But she says, hey, can you come in and talk about tax and asset protection with Simpler? And I said, of course. This is something that's a very confusing area, and in the tax code, it's a bit of a quagmire, so to speak, if you've ever heard of trader status. So just if you can, just put out there, how many of you guys, do you know what trader status is? And just put a yes or a no. You just have to say yes or no. So just say no. So I will be explaining that today. So what we're going to go over, and I know we only have about an hour, and I think I used up some of that time breaking the login. We're going to go over how successful traders take advantage of the tax laws, number one. And that's a big one, because if you're just bleeding money and you don't get to write off your expenses, including Simpler Trading, it makes it really tough to be profitable. Right? If you're having to pay tax on 100% of what you bring in without getting to write off expenses, that's the life of an investor. That is not the life of a trader. And that's not the life of the alternative that I'm going to be showing you guys because trader status is so hard to hit. We're going to talk about why 90% of the traders actually leave money on the table. And believe it or not, they do. And that's because they're not getting the full tax benefits of their activity. And this will make sense here in a second. And then we're going to go over basically how to up your return, because what good is making a 20% return if you have to give half it away? You start getting resentful of your government, because let's be straight up. Not all of us agree with the way our government spends our money. So I don't know about you guys, but I have questions. All right. To help you guys out, because some of these topics, they're going to go over and they're going to go whoosh. When I start talking about trader status, mark-to-market election, being able to unlock ordinary loss of capital gains, how do you do that? When I start going over these, some of them are going to be very exciting. They're going to be a little bit confusing. So I'm going to say, I'm going to give you a link today that lets me know that you guys are from Simpler, but you could still go on to my YouTube channel absolutely free, and you can get very well acquainted with all these ins and outs. And it's absolutely free. And it's easy as typing in Toby Mathis and going into YouTube, but it's very simple. But I'm going to be giving you guys a link that I want you to use, because we want to know that you're coming from Simpler, because it tells us about your level of activity, and it unlocks certain discounts for you too. So I want to make sure that if you're communicating with us and you ask us to do anything on your behalf, even an analysis, that I know it's coming from you, and I'll give you that link later. But you can absolutely go in and educate yourself. I've been posting videos. I don't know if you could see that, but I think there's over 760 videos on that site. If you want to fill yourself up on what it means to be a stock trader versus trader status versus investor, mark-to-market election, when you can get around the wash sale rules, how you can unlock your losses and make them ordinary. I'll go over that with the goal. Real simple is we want to keep more of what we earn. We want to keep control of our funds. We want to defer our tax liabilities as long as possible. All right. I think we can all agree. Is it a good thing to lower your taxes? Like, is it a good thing to pay less tax for you guys? Just say yes or no. I just want to see if you guys are paying attention. Yes or no? Is it a good thing? Yes. All right. So some people say no. I want to make more money, so I want to have a higher. Right. I just want to see it. Yes, of course. Right. Yeah. We should all be on the same page. Yeah. It makes sense. And it's a bigger picture of how all these things work. And I want to show you the methodology. How many of you guys have heard of the book Rich Dad, Poor Dad? I know you could just put in chat, yes, I've heard of it. No, you could just say, no, I haven't. But if you're familiar with Robert Kiyosaki's work, yeah, a classic. I think it was 1998. I bought it for the entire office. We did tax and asset protection for Rich Dad for about 20 years. I'm an avid real estate investor in it. But one of the things that Robert used was a quadrant, and he had you as an employee up in one quadrant, self-employed where you own your job in the bottom quadrant, and then you had businesses that you were investing in, and then investments, and there were different quadrants. And we borrowed some of that and used some of the same philosophy here at Anderson, slightly differently, because what we do is we break your life down into the quadrants so that we can see what type of structure, what type of entity structure we can use that's going to bring you some asset protection, possibly anonymity, but B, also tax relief. And so a lot of times what we're looking at is if we pull this lever, what's the benefit? If it costs $1 but saves us $3, then that's a net benefit, right? That's what we're looking for. And so we put you into quadrants. And what you should know first off is that there's an active side of the quadrants, and then there's a passive side of the quadrants. The active side is where you live. Like, here's you, like maybe you're married, maybe you have some kids, these are pretend they're kids there. I'll give them bodies even. Maybe you have your family, your cat or your dog. They look the same in my world, right? You have your car, you have your house, maybe you have a boat. Let's just put a boat up there. And it's where you have all your personal stuff, including, believe it or not, we're going to put our IRAs and our 401ks in there as well. That's really your personal side. And there's not a ton we can do from an asset protection or tax standpoint in your personal side. What we usually do is put a box around it. And that box is something called a living trust, because we want to control our lives. Now, this is outside the scope of what we're going to be talking about today, but we're putting it in it's almost like a roll-on. It's like, hey, I have all my luggage, and when I'm traveling, I don't want to carry it, so I put it in some baggage, some luggage, and I pull it along. That's the same thing we're doing with your life. We're putting everything into that suitcase so that we don't have to go in front of a court. We don't have to go in front of a judge at some point and ask them to distribute our belongings, right? We're going to handle it ourselves. We're going to handle it personally. We're going to stay away from courts. But that's the living trust. That's the only thing that we can really do on that personal side, other than IRAs and 401ks. Everything else is we're putting them into different quadrants. So for example, if you have a business, maybe you're consulting, maybe you're doing, maybe you're a real estate agent. Let's see if I can make this actually stick. Maybe you're a real estate agent. Maybe you have a pizza shop. I don't really care what it is. It's an active business, sweat of your brow. Maybe you're an Airbnb host. Maybe you have a side gig. Maybe you're doing Turo. Maybe you're doing something where you're making money, but it's active. It's you doing these activities. And I'm going to put one up here, and it's called management or a family office. Believe it or not, all of these activities get preferential tax treatment underneath the code versus you as a personal. All we need to do is separate them out and give them a name. Now, usually we're using a box. I'm just going to say this is a limited liability entity. It could be an LLC or an Inc., but we're going to put a box around a lot of our active business activities. Then we get to the passive side. And this is where a lot of your guys' wealth is held. I would actually say that a brokerage account is a non-risk activity. Your brokerage, your cash, your gold, your crypto, all of those things, currencies, put it in a safe. Like when I'm using an active business, I want tax benefits, and I'm doing what I can to isolate that and get a benefit out of it and isolate it from me personally. When I am putting something in a safe, I'm trying to protect it. So I want you to visualize something with me just for a second. Pretend that you're walking down the street at night in your neighborhood and your neighbor's lights are all on, like you see right into their house, right? It's a little bit evasive, right? But you see a pile of cash on their kitchen table. You just see a big pile of cash and their door is wide open and nobody's to be seen. Like, you're not going to be tempted to go in there and help yourself to that cash, but there's a lot of people that would be, because the door is open and it's clearly visible. The safe thing to do would be to put it someplace else. Now, you might put it in your house. You might put it in a safe inside your house. So your neighbors might close their door, turn off their lights, make it so it's not so visible. Put it in a safe so that if somebody breaks in, maybe they're not going to steal it all. And I'm actually somebody who's actually had a safe removed from his house after I had a bunch of windows put in Seattle about 20 years ago. And when I come back in the following week, the safe disappeared. It was empty, so the punchline's on them, but they unbolted it out of a closet. So even in your house, it might be a little bit at risk. And so what we would do here with these is we put them in LLCs. And we hide them in the desert. Usually we put them in Wyoming. And the reason we do that is because A, nobody can see what you own in that particular jurisdiction. And B, even if they could see it, they still can't take it. And so we call that our safe entity. And we just call it a safe. I am literally putting my brokerage account into a safe. Now, this will all make sense here in a second. Then you have your risk assets where you have your real estate. This is where you have rentals, multifamily, commercial, whatever you're investing in. Maybe you have a couple of duplexes. Those are risky. Just having them causes liability. So let's say that we have a couple of little single family houses. Pretend that says real estate. The issue is we want to make sure that it doesn't come over and creep into our individual realms. So when we're looking at your structure, this is what we're looking at. We're seeing what activities are risky and we want to isolate. What activities are safe and we want to isolate them from you. Because no matter what we do, we can't keep you from being liable for your own activities. Like if your kids go driving, say you have teenagers and they harm somebody, you're going to be on the hook for it, right? You're still responsible. If I do something where I get defamation sued or whatever, and they come after me, it's over here. I need to make sure that my things are separate. Even more importantly, if you have a business, for example, and I see this day in and day out, I've been doing this for 27 years, guys. There'll be a business owner and they'll have all of their money sitting in their business and they'll have an employee claim or they'll have a customer claim. And all of a sudden that money can't be moved. It's called a fraudulent conveyance or avoidable transaction. And the money is stuck in the business. So the trick is making sure that we're keeping separation. Now, here's the punchline. Businesses get preferential treatment under taxes. Some activities get preferential treatment too, but you don't get to take deductions. Marrying them together gives us the best of both worlds, and that's what we end up doing. That's what we're going to be talking about. So there's really three areas we're going to be focusing on. We're going to map that out, and then we're going to say, hey, what are our risks, and what can we do to minimize them? What are some benefits that we could achieve, and what can we do to maximize them? So when I look at lawsuits, the easiest way to explain this is, let's say that I have a pizza business. And then there's me. So I'm out here and I'm driving my car and I do something irresponsible. I hit somebody and they say, I want your pizza business. This is called outside liability. Outside liability. Flip side, let's say something happens in a pizza. Let's say I give somebody a pizza and it makes them sick, and they come after and they sue my pizza shop. The inside liability is inside the pizza business, and I want to isolate those. So we put them in their quadrants, and then we isolate it so that we are protecting ourselves from the activities of our business. It doesn't come over here and get us. So if somebody gets harmed, more likely than not, let's say that it was somebody that got sick, they sued the heck out of me. Maybe I used some bad ingredients or something, and I got some people sick, and they come after me. I need to make sure that it doesn't leave that box and it doesn't come to my personal realm. On the same side, we want to make sure that if I do something, they don't take my business and my livelihood. In your case, you guys probably have a big pile of cash in your brokerage account, and you want to make sure somebody can't take it from you. Yes, I could have that exposure, but I don't want to be forced to have where somebody can just come and garnish my money. I can put up a very simple link or a very simple structure to make it to where somebody cannot get in to my assets unless I give it to them. They can't force me. And because of that, the value of their lawsuits or anything, or if somebody's coming after you, drops. And if we use anonymity, the value of their case goes down even further because they don't even know that you have assets that they're willing to take. Toby, somebody says, if I'm trading daily as a biz in the brokerage, is it still in the non-risk? Yeah, absolutely. That's the funny part. And I'll make sure that I answer your questions by the end. But if I'm trading actively, I still have the cash. But you have to be very clear on this. I'm going to show you a structure where we create the management of that activity and we separate it from the asset itself. Sometimes you might put the entire thing in a management entity. Let's say that your brokerage account is less than $25,000. We might put it directly in a business entity because we're going to deduct everything known to man underneath there. But for a lot of you guys, you have larger, sizable accounts. And what we're going to do is create a structure so that we get the tax benefit at the same time as we get the asset protection. So yes, we'll do that. Somebody says, what about an umbrella insurance for overall protection? I still recommend an umbrella policy, but understand that umbrella policies don't cover everything. They're secondary insurance and they have exclusions. And all too often, we end up with things that are beyond that. And we just want to take it off the table. Again, I've seen just about every scenario you could play out using different structures. And I've seen massive lawsuits. I have a buddy who got a $40 million judgment against a landlord for an injury that occurred on the property. 40 million. There's no umbrella policy on the planet that's going to cover that, right? So what you have to do is make it to where even if somebody gets that win, that they still can't collect. And if everything's easy to collect, there's no reason for someone to back off. And I'll give you a great example. What we do here a lot of the time is making sure that somebody can't find your assets. A lot of it's anonymity. We call it obscurity or security through obscurity. We want to make sure that they can't see what you have. And if we do that right, then when they start a lawsuit, they're already playing from a position of weakness. They're looking at it going, I don't know what a win is. So when a lawyer takes a case, they need to be able to say, here's the chance that we're going to win. If we win, here's the value of the case. And then what's the chances of us collecting? So I'll give you two real life examples. The first example were two siblings and they owned a business together. And that business had a major catastrophic injury. It was actually somebody got run over in a parking lot and there was limbs lost. Let's just leave it at that. Right. And it was a lawsuit that they sued everybody and their mother on. And they sued both of the siblings. One of the siblings was our client, and we had set them up using Wyoming. We'd set them up while we were getting the money out of their businesses so that consistently they were putting the money aside. And yeah, they had large brokerage account. Yes, they had a bunch of other investments. They had a bunch of other real estate. But because of the way we structure it, and we don't want your name in the public record. There's nobody that needs to see that you own a bunch of properties. There's no reason that we have to do that. So we can make it to where your name's not on your house. We'll put it into a trust with an entity as the nominee or as the trustee. Your name's nowhere on it, right? And what it does is when somebody's looking at you and trying to figure out what assets you have, they don't see those things. So there's a big question mark. And when there's a question mark, it devalues their case. So in this particular case, one sibling was our client, and they were let out almost immediately in the case for a peppercorn. It was a small amount of money, less than the retainer for a lawyer. And they went about their way. The other sibling had a big firm in California that was their attorneys, and you could find everything they owned. It was all in LLCs all over the place, but their name was on every one of them because they didn't use anonymity tactics. And in some states you can't. There's always a way to do it, but if you're doing it with the local and they don't do multi-state planning and they're just setting up their local LLC, they could see who the members are. And that was this case. Ended up costing them deep 7 figures. I don't say like $1 million, deep 7 figures. And it took them 4 years, and they got drugged through the mud. And I can just put those two people side by side. The punchline was they were worth about the same. It wasn't that this brother, the one that got drugged through and ended up with the massive amount of expense and having to settle. It wasn't that they had more, is they were fairly equivalent. Our client actually had slightly more assets, but that's how that actually impacts you, is just making sure that these things are not visible. And I'll give you one more. In California, they're a little bit sue happy, and they went after a client. Our client, again, structured anonymity. They could not see what she owned. They ended up not even settling. They dismissed her from the lawsuit outright because they did not believe. And they specifically said, we're looking for the deep pockets. Again, punchline is she has deep pockets, but they can't see it. And she said, I never would have thought that this would have been done to me. Somebody drafted me it was a frivolous suit. There was some exposure, but not to her. They were just trying to bring everybody in. And if they can get 1% liability, they can collect the judgment against that individual. Something called joint and several liability. But they were just shaking everybody down. And when they did not see what she had, when they did their investigation, they came back and said, yeah, we'll let you out, because they only want the deep pockets. That's how that works. But you guys are really here because we want to talk about the preferential treatment that comes from the taxes. And I'll explain that for you traders out there. The last thing is death and disability. When we put together a structure, one of the reasons we do it is because entities don't die. It's a much more convenient vehicle than having to go through and each asset going through a court-ordered process like probate. I want to avoid that to the extent humanly possible. And when we use entities, they don't die along with us. So it's very easy to use trusts and LLCs so that we don't, or corporations even come into the mix sometimes, and sometimes exempt entities, nonprofits, sometimes solo 401ks. These things do not die along with us. So there's a way to set things up to where your family does not have to go through a court process. Everything's already organized. And when somebody passes away, it's not that 2 years of pain and suffering of having to go through a probate process and having to deal with it, but it's 2 weeks of a little bit of administrative work and you're done, and you never had to go visit the judge. That's our goal. And by the way, during COVID, we've had plenty of clients that got affected during that period of time, and we've had a lot of clients that have passed since that time for various reasons. And you look at it and like, it was just like on turbo, right? All these, we've been doing estate plans for years. And then there was a stretch where it was pretty active. And there was some unfortunate circumstances where people lost their lives to that disease. And it's helpful. There's nothing that's going to take away that pain. But when you're talking to somebody like the family, the kids, and there's businesses and there's investments, and you say, don't worry, this is how it was already set up. And here's what we actually did, and here's a map of it. That it's nice from our standpoint to be able to bring down the pain level a little bit, because it's really frustrating for those folks when somebody passes away and you end up having to go through a long process. So these things all marry together. But let's talk about money in your pocket, because that's ultimately what tends to motivate folks. Is they look at it and they say, man, this tax system is just so nasty. Look at these taxes. I'm looking at this. Here's for single, here's our married filing jointly. And you could see we go all the way up to 37%. The more you make, the more they take. And then we look at long-term capital gains down here, and we realize how extraordinary it can be for investors if they're willing to structure themselves accordingly, where they can get the benefit of these. So for some of you guys may be in the 0% tax bracket. If you're married filing jointly, and after your exclusion, which is about $28,000 this year, if after that your income is $94,000 or below, you're in the 0% long-term capital gains bracket. And by the way, that's the same thing for dividends. So let's talk about the different types of taxes. I'm just going to throw them up here so that we're all talking the same language. And then I'm going to apply it directly to the traders so you understand why it's actually relevant. But you have earned income. And this is like, I worked at McDonald's when I was 16. I made $4.15 an hour, and I worked 40 hours. And I thought, I'm going to get about $160. No, you don't get $160 because you have OADSI, FUTA, SUTA, you have withholding, you have all these things. When it's taxed from the federal standpoint, it's taxed as ordinary income at 0 to 37%. And then you have this thing called FICA, Social Security, which is an additional 15.3%. There's a partial deduction. It ends up being mathematically 14.1%. And your employer pays half if you're an employee. If you are a sole proprietor, you're paying both halves. But it can get pretty expensive when you have that earned income. And that's, again, in that quadrant, when we drop our quadrants, that's that upper left quadrant, your personal realm. And they really are just giving you a whack every time they give you a paycheck. The IRS is taking its shot at you and telling you, to me, they're telling me not to do that. They're saying minimize this activity and instead go down here where everything but down here is no FICA, right? Everything below this line is no FICA. So you immediately get a benefit of about, it's about, I'd say 15.3%. But again, the tax math ends up being about 14%. But you immediately get that benefit. Royalties, generally taxed as ordinary income. In some cases with oil and gas, it might even be less because you might be only taxed on a portion, I think 85%. Some royalties are actually earned income if you are writing or creating music or things that actually generate it. Then it could pop up there. But if it's not sweat of your brow, you're just an investor, you're fine. This is the same thing for interest, is ordinary income. And then that is ordinary income. That's that same 0 to 37%. But then we get to dividends. Oh, dividends. We like our dividends. They're taxed at 0, 15, or 20%. They're taxed as long-term capital gains. So if it's qualified dividends, that means U.S. companies paying out dividends to its shareholders, they're qualified. So they end up being 0, 15, or 20%. And that's long-term. And that's also the same bracket for folks that are greater than 1 year when they hold it. Now, there's also futures. So there's something called 1256 contracts where it's 60% long-term. And then you get 40% at ordinary bracket. But capital gains are one of those interesting areas where worst case scenario, when we have short-term capital gains, they're taxed as ordinary. And so if we hold less than 1 year, it's going to be taxed as ordinary. Never FICA though. Never that Social Security tax, no matter whether you're an active trader or you're just an investor. And I'll go over those terms here in a second. And the downside is that capital losses only offset capital gains, except you can write off $3,000 a year against your other income sources. So capital losses offset capital gains. If you have excess capital losses, then you can write off $3,000 a year against your other income sources. So if you have, this is where it gets interesting with traders, you're stuck in that capital realm unless you do something called a mark-to-market election. If you make a mark-to-market election and you qualify as a trader, which I'll go over here in a second, then you could treat those as ordinary loss. Then we get our friends, the passive income. Passive income, there's only two types, guys. There's rents and there's businesses with no participation. I'm going to say no participation. It's considered no material participation, it means you're a silent business owner, like you're a silent partner in a business. And these are taxed as ordinary, but passive losses only offset passive income. What you are doing is not passive. So when you're trading in the stock market, your portfolio income, unless you make a mark-to-market election, and you're treated as capital gains. Passive income is rents that you make, business. You know, it's technically, if you do a short-term rental, you're actually up here. You're going to be in the ordinary income bracket. But if its average use is 7 days or greater, so you're renting it long, then it's going to be considered passive income. There's two exceptions, by the way, to that loss rule: active participation in real estate and real estate professional, outside the scope of what we're going to be talking about, but still something just to think about when we're looking at the passive activities. Now, for you guys, again, what we see with traders, and I've been doing this for a long time. I remember the dot-com bust and people had losses. What ends up happening is, unless you're going to continue trading, sometimes you'll have losses in a year and you'll just be sitting on them. So always know that when you have a passive or a capital loss carry forward, that means I have an appetite for capital gains. So I want to be looking at other capital assets. That's the time when you're actually saying, hey, it benefits me to continue to invest. When you're doing the passive activities and you have passive losses, there is a time when passive losses can become ordinary. So there's the two exclusions, but also when you get rid of the activity. So if you sell a rental property, for example, you can, that would flow down onto your return. So if I sell a property, the loss gets released, and that loss will be used against the income that's generated from that sale. Somebody asked, does a 1256 income from an LLC flow into my 1040? And the answer is yes. The nature of the income, the way we structure it's going to flow onto your return just normal. So I'm going to go over all that. And then somebody says, would setting up a trading as a business affect my Social Security benefits? No, it does not. Since the nature of the activity, the way we do it is going to remain capital. There is a way to make it turn into active income, this earned income, but that's only if you use a corporation and start drawing a salary. And we're going to say, don't do that. I'm going to show you how to control that so that you don't have to worry about it. So our U.S. tax system, you now know the difference between capital gains and ordinary income. This is 37%. If this is long-term, it could be a high of 20%. There's something called the net investment income tax for high income earners that adds 3.8 to that. Short-term is equal to that 37% too, up to 37%. Now let's talk about the difference between investors and traders. Investors can't write anything off. You get to write off your interest expense against the interest income. You know, so like if you're making, you get a tiny little deduction if you're making money using some margin. That's about it. Your simpler expense, paying for an accountant, your computers, internet. I mean, there's a whole laundry list. I always have a list rolling around here. Like, let's just look all your startup expense, custodial fees, trader guides, subscriptions to financial magazines, etc. Any advice that you're seeking, anybody that you're paying, real-time quotes, all that stuff, you can't deduct. There's no such thing as a investment expense that's miscellaneous itemized expense anymore. They went away in 2017 under the Tax Cut and Jobs Act. So you don't get to write those things off. The only way you write those off is if your activity rises to the level of a trader business as a trader. And that will allow you to unlock those. But you also get the benefit of getting audited all the time when you're doing that. We'll get there in just a second. 1256 contracts. This is a 60-40 split between long-term capital gains, short-term capital gains, no matter how long you hold. And you already know the difference between short-term and long-term. This mark-to-market, I am not a fan. I'll just tell you that if you want to unlock your losses and make them ordinary, this is the way you do it. And you have to qualify first as a trader. Then you have to make a valid mark-to-market election. Either one of those not done, you don't get the loss. But I lived through a situation where I watched a lot of clients harmed by this election. There was a time in, I think it was 99, Qualcomm ran up just crazy one month at the end of the year. A bunch of people had leaps. They saw massive non-realized gain, and a mark to market makes it treat as though you sell everything on 12/31, even if you hold it. So these people had this massive gain that they didn't actually realize. And then the following months, the stock went down and they ended up owing taxes on those gains, but they didn't have the funds to pay it. So even if they sold their stock, they didn't have enough money to pay for the tax bill. And so I am not a huge fan of that mark to market. I've seen too many people hurt by it. And frankly, I try, like, if you're trading to lose money, you're probably doing the wrong thing. So, I work with people all the time, and it's about making money. Let's make sure that we're looking at profitability. Understand where you are from a trading standpoint, because it does impact taxes. Your futures can be taxed as 1256. Your Forex could be taxed as 1256 or something called 988 ordinary, which you could actually have deductions. So whatever type of activity you're doing, it matters to us. You may be looking at it going, hey, it's just money I'm making. But from a tax standpoint, it actually matters. Stocks and options are taxed differently. For example, options, you just have to know that, hey, the commissions get added into the basis. They're taxable when they're exercised, or when you buy and sell them, or when they expire. So if you're selling calls, for example, and you get a bunch of money, that's not actually taxable until one of those other three things occurs. It's exercise, buy or sell, or expires. So there's situations where people have a lot of money come in, especially if you're selling leaps and things like that, depending on the type of activity you're doing, where it's kind of surprising. And then crypto is interesting because it's taxed as a capital asset, even though people think of it as a currency. It's not. It's treated as a capital asset to the IRS, so it's treated as capital gains. When you create crypto, like if you're mining, that's active ordinary income. And then it has its basis on the day that you mine it. And then if you sell it later, it's either going to be long-term or short-term capital gains, depending on how long you held it. So it's kind of fun, right? There's all these difference. Whether or not you get to take deductions is a whole other thing. When you are just doing your stock and trading investing as an individual, there's no expenses. You don't get a Schedule C. You're not writing it off on Schedule A. There's no miscellaneous itemized deduction. It's showing up on Schedule D, and no, there's no deductions. And then you have the capital loss limitation. Trader status is that place where people like to say, hey, I am an active business, and I'll go over the rules for that. I would advise you not to do that. But you can kind of see the different treatment here. All of them have different types of tax consequences. So when we talk to somebody, and when we sit down and talk to you, for example, and you start saying, here's the type of trading I'm doing, a lot of times we're trying to figure out what's the likely tax treatment of those, because they're treated so different. And even the losses could be treated different if there are losses. Or what do the offsets look like? Hey, a lot of people misunderstand wash sale, for example. This is kind of a freebie for you guys. There's a workaround for the wash sale rule. A lot of people don't realize it. So if you have gain in a year and you want to take on, let's say you have unrealized loss, but you still want to own the position, you actually sell the stock and then you buy an option in the money. And yes, that's the wash sale rule. The basis of that sale now flows over into that new option, and then you buy back the stock again. Well, now you own the option in the money and you own the stock, but the wash sale loss is attached to the options. So you bought that, you sell it, now you realize that loss, and you still own the shares. So there's always a workaround when you're playing in the tax code as to achieve an objective. It just depends on your situation. The big thing to remember, though, is the treatment between you as an individual, as an investor in a business, is completely different. And it's not as good as an individual. Individuals earn money. We get our taxes taken out, and then we get to spend what is left. Businesses, on the flip side, earn their money, and then they spend away, and then they pay tax on what is left. So we want to make sure that we are trading as a business. Now, the tax code treats these two activities very differently. For example, if I'm Toby the plumber and I'm out there and I'm like, hey, I'm going to start my plumbing business. Let's say that I make $100,000 doing my plumbing. And let's say that I have expenses of 30,000, 30%. Both activities. Let's say I make $100,000 as a trader. I'm doing great. And I have expenses of $30,000. Well, as the plumber, I could not only do I get to take that expense and get myself down to 70,000, but I could also fund, let's say, a 401k or a defined benefit plan. Let's say that I put an extra $20,000 into a 401k. I can defer far more than that, but let's just say that's all I did. And I have a total profit of $50,000. My taxable income on that, let's just say, what would be a good one? I also get a 199A deduction on that too, which is a 20% deduction as a flow through business if that's an S corp. So let's just say that I have taxable income of $40,000, and let's just say a tax foundation says the average is about 30% that we pay in tax. So that's about a $12,000 tax bill. So my tax bill is $12,000. Trader, you don't get to write off the expense at all. If you're considered an investor, you get that $3,000 a year loss limitation. You can't fund your retirement plan with it. You don't get a 199A deduction. And so what you end up with is you end up with $100,000. You end up with a $30,000 tax bill. Two activities, same level of expense that they're both incurring. One gets treated far differently. It's about an $18,000 difference. And that's why we say, you know what? We're going to look at our choices and we're going to put ourselves in a situation where we are not in that, where we're not in a losing position. The types of activities you have, you can be an investor. You could be a trader, or you could be a trader, a trader with mark to market. Completely different treatments. This is if you as an individual. I'm going to tell you 99% of the time we take you away from this because it gets too crazy. With an investor, you get no expenses. With a trader, you get to write off expenses. Get this. As a trader, you're writing off your expenses on Schedule C of your 1040, but your income is still capital on Schedule D. In other words, you just have a bunch of expenses sitting on a Schedule C. You wonder why they get audited all the time? Because that's the number one way to get audited is show losses on a Schedule C. Better yet, show no income and just take deductions. You're violating a number of sections there, but it's just like you're waving a flag saying, please audit me. Trader with mark to market is you write off your expenses, but everything's on your Schedule C, and you don't have to play that game. You don't have you don't have employment taxes on any of these still, because it's still considered that portfolio income, which makes a huge difference. But when we're looking at these, it can make a huge difference from a tax standpoint. So let's just say, hey, I made $50,000 one year and I had $20,000 of expenses. Well, in this category, I'm paying taxed. You're taxed. Taxed. Let's see if I can make this stop doing that. You're taxed. A doesn't want to stay there. Taxed at on the full 50K. As a trader, you're taxed on 30. And as a trader with mark to market, you're taxed on 30,000. The difference with the mark to market is you don't have wash sale rules. You don't have the $3,000 loss limitation, but it's not going to change anything here. Now let's change it up and say that you have $50,000 loss plus you have $20,000 of expenses, and this is where it makes a difference. So here you're going to have a $50,000. You don't get your expense. So as an investor, you end up with a $50,000 loss. As a trader, under that same scenario, you have $50,000 and you get to take your expenses. You have a $70,000 loss, but you're limited to $3,000 a year. So you're going to be carrying it forward for a long time. As a trader with mark to market, you get your $70,000 loss, and you get to take it against all other income. That's why people like that. Me personally, I try to use a trading structure because I'm going to, again, if you're in this for the losses, wrong business. And that's because from a trader standpoint, I want those expenses, but I don't want the audit that comes along with it. And I'm going to find another way. Like, not only are the expenses better if I'm a business, I'll go over that in a minute, but I get myself out of that firing line. Now, if you are somebody who trades a lot, and I'll give you the golden rules is what qualifies as a trader. You need to know you're going in a facts and circumstance test. This is not a bright line. Here's the rules. This is, they get to say, do you seek profit from the daily market movements? Is the activity substantial? In other words, is it more than, in some cases, it has to be more than 40% of your income? Are you doing this on a regular and continuous activity? Any of these things is a reason for them to deny you from being a trader. Are you making money on short-term movements in the market? And you cannot be using anybody else. You got to be doing this on your own, right? You're using anybody else. And if you want to make that mark-to-market election, it has to be made the year of the election. So like we have until, I think it's March 15th, you're going to have to make your mark-to-market election for 2024. And you have to, it's one of those things it's almost like you have to be omnipotent and have a crystal ball. Hey, I'm going to lose a bunch of money this year. And you make that mark-to-market election. Again, I tend to shy away from the mark-to-market election. Once we go down and we start looking at the IRS's treatment of this, you'll realize that this is just a war field. For 27 years, I've been following this stuff. You have folks that have $10, $15 million trading accounts being denied trader status. You have folks with over 1,000 trades being denied trader status. You have folks that made their living but don't trade on 75% of the trading days. I'm not kidding you, being denied trading status, even though they make their living doing it, because they say, well, business would be more active than that. It'd be regular and continuous, right? They don't, there was a guy, he was trading 6 months out of the year and making his living doing it, not a trader. So it's a facts and circumstance, which means we're going to go to court. So we don't want to. So here's the rules that you follow. If you're going to go down this realm, don't even consider it unless you're hitting these. These are kind of I call them kind of a golden rule, but it's an easy rule. I want to see 1,000 trades per year. Some of you guys are there. I want to see 75% of the trading days. The average holding period, this is a bright line test, has to be less than 31 days. So you cannot have holding periods greater than that 30 days. Retirement accounts do not count towards this. So IRAs and 401ks do not count. Money managers don't count. And you got to have a minimum of $50,000. It has to be substantial activity. If this is you, then you might qualify as a trader and you might get your expenses. If it's not, then what we do is we create a formal business structure. We create an asset protection structure. So there's multiple benefits for this. But by doing this structure, and I'll show you what it looks like, you end up with not only protecting the trading account, but now we're unlocking a different type of deduction. When you and I are writing things off, for example, this cell phone, if I'm a sole proprietor, if I'm writing this off on a Schedule C, I only get to write off the portion that I'm using for business. So if I'm a trader, I don't get to write off my cell phone. I get to write off the business use of that cell phone. When I use a different structure and I use a corporation from a tax perspective, it can be an LLC taxed as a corporation, but a corporation, I can write this thing off 100%. It's something called an accountable plan. All of a sudden I lock up and I can use my house. Right now I'm in my home. I have a business office in my home. My company can reimburse me the percentage square footage or room methodology, which is about 20% of my expenses for my house, including any mortgages I pay, the mortgage interest, the expense, the real estate taxes, cleaners, utilities, whatever, 20%, I can literally reimburse myself 20% of this using room methodology. Everybody's facts are a little bit different. It depends. It might be more, it might be slightly less, but it's certainly going to be something more than a home office deduction. This is something completely different. There's also something called 280A that allows us to write off having a monthly meeting in your home, right? There's so many things that get unlocked when you use a corporate structure as opposed to an individual, or even trying to do this as a trader. It's two different worlds, and it makes a huge difference. The question that we oftentimes get is, well, if I'm going to be an entity and I have to take money out, my accountant told me to be double taxed, or they told me I had to take a salary. We are using a two-entity structure. Now, first off, in order to have to take a salary out of a corporation, you got to have profit. So if all we're doing is zeroing you out, so let's say you're somebody and you have $10,000 a year that you're making and you have expenses of about the same, we'll just use one corp. Like you just use an LLC tax as a corp and you'll be fine. But it's probably going to be a smaller brokerage account. If you're above that, then we're actually going to use a two structure, and I'll show you how it works. We're going to set up an LLC to hold the brokerage account. Now, I'm going to say for asset protection, I like to use Wyoming. Now, by the way, if you do LLCs, know that your brokerage account may want to charge you professional, additional higher fees on it and treat you as a professional trader. Just use I'll show you how to use a personal property trust to get around that. And we just use that and assign it to the LLC. It's the same as owning it directly in the LLC. But there's always a workaround from anything that they try to throw at you that says, oh, we're going to charge you this, or we're going to do this. Haven't seen that much in the last couple of years. For a while there, it was kind of hot where they were trying to, if you opened up a brokerage account in LLC, they wanted to charge you more. In which case, okay, then we'll just open it up in a personal trust and make the LLC the beneficiary, and it's the same difference. So we put it in an LLC, and again, I'm going to say Wyoming. It could be your home state if you didn't want to go that route, but it's going to be held, the brokerage account, in a partnership LLC, and one of the partners is going to be an LLC that's taxed as a corporation, and that's all it is. Is the corporation is going to be, generally speaking, probably a 20% owner, and what that allows you to do is we're not writing off management fees. We're not paying it like we're paying a money manager. It's literally flowing into the corporation by virtue of its ownership. You can pay the corporation an additional amount. It's called a guaranteed payment to partner if you wanted to reduce it further. Everybody's facts and circumstances are different. And so I'm not going to say there's a bright line rule, but I'm going to say that you have the ability to be very flexible with it. And it gives you all these benefits. What it looks like is this. Here's your brokerage account. Let's say that you have, I'm just going to make you $1 million. Let's just put some money in your account. And we're going to have a corporation sit over here, an LLC taxed as, or a corporation. And it's going to own, let's just say 20% of that LLC. What ends up happening is, and before anybody says, "Whoa, how do I get the money back out?" You can always return capital from a corporation. So if you set this up, it's tax neutral. If you dissolve it, it's tax neutral. But what we care about is, let's say that it makes $100,000. $20,000 comes up here. And that's what you're going to be writing off and reimbursing things that you're already paying for. Chances are you already have all these expenses. You're just not getting to write them off. So your cell phone, your equipment, your computer, your subscription service, costs even simpler things you're paying to simpler. All of that becomes a deduction through this reimbursement. And if that's all we did, then $80,000 flows out to us just like it was in our individual name. No difference. It flows out as capital, ends up on as capital gains or capital losses, ends up on your Schedule D. It's not going to change things. But what we did is we took $20,000 off the top. So depending on your tax bracket, if you're in the 37% tax bracket, then federally that just saved you $7,400. And it does that every year, right? That's what we're doing. Now, for this amount of money, I would probably be saying, let's do a guaranteed payment. It's called a guaranteed payment to partner. And maybe it's going to be an extra, let's just say $2,000 a month. And we're going to pay the corporation. This is like a family office. This is the way to think of this corporation. And let's just say we paid it an additional $24,000. And we had other expenses. Maybe we're doing other activities. Maybe this corporation, by the way, could also be managing my real estate. So maybe I have a real estate holding entity over here, real estate LLC. Maybe it has other activities. Maybe it's doing some side gigs and it wants to, and maybe you're building other businesses. Maybe there's expenses associated with that. But that allows us to write off another $24,000 and reduce our taxation even further. So we end up, what was that, around $56,000? So then it ends up being, hey, I would have paid $100K versus tax on $56K. It's not any more difficult than that. That's about the math. That's what we look at when we do analysis with people. We're sitting them down saying, hey, what's going to be best for you? Where do you set this up? Trading activities are interstate commerce. So you could set it up wherever you want. You could set it up in your backyard. You could set it up in Wyoming. It really depends on your risk and what other assets you have. And when I say risk, like let's say you're a doctor, I'm probably taking this out to Wyoming. Why? Because I never want a lawsuit to be based off of what somebody can find that you own. And that's all there is to it. It's like, if I can see that you own things, like it's bad enough to have a hunch that somebody has deep pockets, but once you start seeing their stuff and you can start saying, hey, I see that you have 6 LLCs, and we checked them out and we could see that they own some things. We ran some searches and we could see that they own a bunch of real estate. You have a lot to lose. If we want to take that off the table, then we go to Wyoming. Plus, you remember Elon Musk, he just yesterday, the Delaware Court of Chancery just undid his compensation program, right? People always say, like, why aren't you in Delaware? That's why, plus the franchise fees that they charge, plus they have overly intrusive, like it's pro shareholder in that state. I want pro management in my state. In Wyoming, there's none better. Some people are saying, what about South Dakota? South Dakota are good for trusts, not so great. Not so great if you're trying to get something on a management side. So I can also see a few more questions. I'll make sure I answer them in a second. Last thing, if you want to talk about this, then for simpler trading clients is why it's really important that you use this link. We get to know you. We're going to do a free analysis for you. And it's basically, we're going to do a complete tax and asset protection assessment. There's no obligation. It doesn't cost you anything. And we can actually say what it would look like and what it could save you. There's a difference between like, hey, this is what I think, and actually saying, all right, let's take a look at last year's tax returns. Let's take a look at what you're doing this year. And, oh, this is what you're making. Here's what you could do. And here's what you can accomplish. And this is what it will cost. And so this is what I always say. It's not about cost. It's about value. And I've known this for many years. I had really great mentors, and they always said, if something comes along that's good, take advantage of it, right? And what you're focusing on is, what does it give me? How do I take advantage of it? As opposed to if I fixate on cost, and here I took the cost out of it, so hopefully this is a no-brainer. But when you're doing tax planning, I use the analysis of about 7 to 10x. So if I am doing something, I want to benefit about 7 times whatever it costs me. Now, hopefully it costs me once, and maybe there's an ongoing cost. Like here, there might be a couple tax returns, right? So I would just say, hey, based off of this, what am I going to get? What is the benefit, the net benefit to me? And if I can do a 7x return or a 10x return, I'm doing it, right? It's the old, is the juice worth the squeeze? And so that's what I'm going to be focusing on, is what is the overall benefit to me as the taxpayer, and what am I setting up from a structure standpoint? What is my peace of mind worth? And does it incorporate well with my planning? And the answer, hopefully, is a positive to you. If it's not, we're the first one to tell you, like, hey, this might be a little early. Here, there's some deductions that you're losing out on, but they're not going to move the needle on you. Like, it's costing you an extra $500 a year. It's not going to be worth doing a structure. If it's going to save you $5,000 a year, it might be. So it all depends on what that net benefit. So anyway, so that is that. This is what it looks like when you click on that link. And don't worry, again, we're pretty mellow. There's about 500 of us here at Anderson. We've been doing this for 25 years. I've been doing it for 27, but Anderson's been around since 99. And we're some of the best in the nation as far as putting these structures together. I'll put this link back up so you can look at it. But I wanted to honor your guys' time. I know I was a little bit late. Now we've gone a little bit late. If there is time, somebody from Simpler, let me know if it's okay if I answer some questions, or whether we need to be hightailing it out of here. I want to honor. I know it was supposed to be an hour, and I think we went over a little bit. Is it okay if I answer some questions? You just let me know. Please do. There we go. Then let's answer some questions. I'm going to scroll up and see if I can find some of the older questions. Somebody says, why not just trade everything in an IRA and not worry about ordinary term? Dinesh, you're right on. The reason that you don't necessarily do that is because that's a deferral. If I trade in an IRA, and unless it's a Roth, but if I'm trading in an IRA, it's going to come out to me as ordinary income at some point. I'm going to pay tax on it. So here, what if I can get a bunch of things that I'm already paying tax on and get that money back in my pocket? And I'll never pay tax on that ever. I might do that. And that's why. But I'm still with you. Like, you're looking at it saying, where am I able to access? What am I able to put money into? Like, some of you guys probably don't even realize this. We can get about $69,000 a year into a Roth 401k. And I didn't misstate that. There's a way to, with a business, once we have a corporation, we can actually have it sponsor retirement plans. There are people out there that are in a position where they have tax losses, or they're doing real estate and they're able to unlock some losses. And they're like, my tax burden right now is really low. Can I overfund some of these things, pay tax on it now, knowing that I'll never pay tax again? And they already have losses to cover that. The answer is yes. There's 3 buckets when you're in a 401k. There's the employee deferral bucket. There's the employer contribution. And then there's an employee non-deferral Roth bucket. And what you do is you overfund the employee bucket, enroll it, as long as your plan documents allow in-plan distributions, right over during that tax year. Never took a deduction. We still get taxed in theory on that amount, but now it's sitting over in a Roth bucket. Yes, you could do that. The IRS actually explains it and tells us how to do it. It works. Can you have a mark-to-market on one account and another account that uses a long-term tax manager? Yes, you can actually have different accounts. Generally speaking, you would do it as a partnership, or you do it as an entity and make that election. Otherwise, as an individual, you're making a mark-to-market, but only on your trader activities. So it's important to remember that there's a distinction. That there's a distinction between trader activities and investor activities. The only ones that qualify for mark-to-market is I have to be a trader first. So all these court cases we see, quite often it's somebody with losses. Like, there was one guy, he had almost $20 million of losses. He was a personal injury lawyer that thought he was going to become a trader, and he just blew himself up. And he wanted to write off those losses as ordinary, but he didn't make a mark-to-market election, and he didn't qualify as a trader. And the court will sometimes humor you and say, well, you could be a trader, but you didn't make the mark-to-market election. We see that over and over again. So they'll give dicta like, well, it looks like your account, so let's assume you were a trader. You still didn't make this election, so you still lose your case. There's people that grab those cases and say, see, this is how you be a trader. No, you don't understand tax court. They're just saying, hey, even if I gave you this bone, it doesn't mean anything. It doesn't move the needle. But yes, you can do it different. I don't recall, but with trader status or trading under an LLC, doesn't one of them have Roth benefits where you can contribute more? Yes, Rich, you can absolutely do what I was just talking about. Is once you have once the structure here, I'll show you how it looks. Let's say that I have this structure. I'll make it clear. I'll just, maybe I can erase this whole slide. Erase all ink on slide. And I'll bring my pen back. So I have a structure that looks like this. So I have my trading account in an LLC, and I have my friend, the corporation. I hang a 401k off of it. Now, I am going to have a tax issue when I contribute and pay myself money that gets deferred. I'm going to have to pay the FICA on that. But yes, I could put, and I wouldn't take a deferral, but I could put, what is the number this year? Shoot, I want to say it's for folks over 50, it's over 30,000. So I think it's like, I should know this off the top of my head, but I think it's like 22,500 that you could put into a Roth, just deferral. Plus you have a makeup if you're over 50, but you can absolutely do that. And of course, you could overfund your employee contribution amount as long as you take a wage that's equal to whatever you're putting in there. So let's say that I took a wage of 50 grand. I could put a $50,000 into a Roth component. I don't get a deduction for it, but I could absolutely do it. What about single member LLC that uses mark-to-market election? You could still do it. I would say that that's not a bad idea as long as you first qualify as a trader. So step one is, am I a trader? If I am a trader, then does it make sense to do the mark-to-market? Could I use a single member LLC for that? Yes, you could. And it works just fine. But again, first step is, am I a trader? If yes, then I can do that mark-to-market. Otherwise, I'm just going to keep going away and just do my structure. Toby, do we need to take a salary if we want to contribute to post-tax 401k? You do, but you could defer the whole thing, right? So I have to take a salary out to be able to contribute. The business can contribute up to 25% of that amount as well. So when you do 401ks, solo 401ks, which we do here at Anderson, like our plan docs do everything that I'm explaining here. Some people use a third party, and sometimes they may or may not allow like in-service rollovers and things like that, in-service distributions. But yes, you can absolutely set it up and then pay into it, and you have the employee contribution portion, and then you have the employer contribution where it's 25% of whatever your compensation was. So if you paid yourself, let's say $50,000, you overfunded your employee side, and then your employer said, I want to make a contribution. The entity itself could make an additional, in that case would be $12,500 contribution into that 401k and take a deduction for it. Will the recording be available? I assume that the recording will be available, and I'm glad to make it. I would cut out the first 5-10 minutes when we're trying to get in. I got locked out, and it was some email fun stuff where we're using a different email and info. Yeah, so the entire recording will be available. Toby, I have a brokerage that will not allow my LLC to open an account because there are 2 or more partners. How do you work around that? Lorna, what I would do is set up the LLC with one partner. If they have an issue with it, I would set it up with one and then add another partner. Or I would set up it as a land or as a personal property trust with just you, and then have another grantor come in and get it done that way. I understand Wyoming. Have you used South Dakota? I think I already went over that. We don't use South Dakota for the LLCs. They're great for asset protection trusts, but Nevada is the #1 state for asset protection trusts. Somebody else, Toby, if asset protection is your #1 goal for your trading account, could you just use a single member LLC initially? Yes. That is just pass through for tax services. Yes. Wyoming close LLC. We just use a single member LLC. And then later on, you could have a trading single member LLC partner with a C Corp. Yep. And then do it. Yes, JT, you're absolutely 100% correct. So hopefully you guys can kind of read these as I'm going through them too. They're in the main chat. I don't know if you guys have access to them, but yes, you could absolutely set this up to start as a single member LLC. You're not going to get the same tax benefits, but asset protection is a very real goal for a lot of people. Some folks are like, oh, asset protection. I've seen people lose everything. So I had a 80-some-year-old lady, that's just sound horrible, an 80-year-old individual attend one of real estate courses. And I remember this was right around 2000, and like markedly older than everybody else. And she was talking about, she was learning basically, at that time, LLCs weren't recognized in all 50 jurisdictions. But I remember she was learning about asset protection. And I said, hey, what brings you out? And she goes, can I be honest with you? I just went through this. Lost 15 properties. She had a electrocution on one of her commercial properties, and I had insurance, and I had property management, and the two wrongful deaths, young men that electrocuted themselves while window washing. They touched a high energy wire, so they touched one of the lines into the building with one of their aluminum poles that they were using with a squeegee. And one guy electrocuted himself. His buddy sees him, and it's not like in the movies where they fly off and your hair turns big. He just stopped and was slowly shaken. So he thought that he was having a seizure or something. Tries to go up the ladder, aluminum ladder, never makes it off the ground. And he ended up with two young men with a massive amount of liability, and no insurance policy in the world is going to cover that. Right. So they actually found a way out because they said that the two individuals did not have current bonding. So they had to be licensed and bonded, and their bond had expired. So they said that they weren't responsible for it. So there was a fight with the insurance company. But the long story short is she lost 15 pieces of property because they kept foreclosing on one. They would go attach another one, foreclose on it, go touch another one, foreclose on it, and she lost everything. That person's going to have a little bit of a different view on these things than somebody who's never gone through a lawsuit. I would just say that if you never go through a lawsuit, fantastic. No good goes on inside courtrooms, right? If you never go through a lawsuit, that's great. But if you do, we want to minimize the amount of time we actually have to spend in the courtroom or avoid it entirely. Isn't there a new rule that says all officers and owners have to be registered with the federal government? If so, doesn't that pierce the anonymity of your LLCs and corporations? So, Linda, there is. It's called the Corporate Transparency Act, and it's the same thing your banks have been doing with the Know Your Client. It's the same depository. It's with the federal treasury. It's called FinCEN, so it's the federal crime component of the treasury. And yes, your beneficial ownership information is there. Plus, folks like me who file entities are there. We have to disclose so they could see if there's anything there with money launderers, right? They're trying to see if somebody's controlling businesses that they don't own, and they want to see who these individuals are. So for big companies, for example, their CFO would be there. So if you start seeing that same CFO on a bunch of other entities, then they're supposedly able to track and do something with that information. But it's not a public record. So it doesn't pierce your anonymity because it's not a public database. In fact, they have to protect it. If you, I don't know if you guys saw in the news that the individual that leaked the tax returns of like Elon Musk, I think it was Trump's returns too. But that individual just got, I think it was 11 years. It was a lot. It was, they got hit. It's a crime for them to disclose your information. Now, we're not big billionaires and somebody, and politicians where they're trying to go after us, but it does not pierce your public record anonymity. It does give that record, and that's just, you're already doing it when you open up a bank account anyway. What would be the minimum net worth that makes this strategy worthwhile? Big West, it's not so much the net worth, it's the amount of income you're generating. So if I'm a doctor and I buy a small rental property in Indy, it doesn't matter what that property is worth. I'm going to put a box around it and protect it. If I am a doctor and I have exposure, I'm not worried about how much I'm making. I'm actually going to put this structure together just to keep it out of my name and keep it away. If I am somebody that's just getting started and I have expenses and I can't write off any of those expenses, maybe it's $10,000 a year. Depending on their tax bracket, it's going to be whether it's worth it. It might be a push. Right. So it all depends on those circumstances. But the idea is let's figure out what it is. Michelle says, how is Florida for LLCs? I have a single member LLC I trade under there. I thought you had set up based on your state of residence. So you are in the world of the one state where they have a case where the single owner LLC was pierced. So Florida is not the best for single member LLCs. It's not going to give you the protection that you think. Yeah, that's, I'm trying to think of the name of the case. But it absolutely, they did it was a fraud case. So it was the FDA, I think it was the FDA, but they were it was a husband and wife, and they said, we're not going to give, like, there's no outside parties that we're going to protect here. So they pierced it and everybody freaked out. I haven't seen too many piercings, but they specifically said, they actually cited the Nevada statute as if they had wanted to have the protection for single member, they would have said so. Like, they would have been explicit in their language. And that same language that's in Nevada is in Wyoming. And they're both great jurisdictions. We set up there both, but Nevada is about $400 a year in filing fees, whereas Wyoming's like 50, so $50. So we're going to go where it's cheaper. What is a good balance in trading to start the structure? Brett, I would say probably over 35,000. You're probably, depending on how active you are and how much you're making, it usually makes sense. You might start with the corp structure to, depending on how much you're making. If you're making 10,000 a year, it might be that I just start trading through a corp and write everything off. Which corporate structure avoids the need to pay taxes on a quarterly basis? Individually, you always have to pay tax. You pay as you go. So none of these are going to avoid that. But the entities themselves don't have to pay quarterly until they actually start making money. And then if they're making money, then they start paying quarterly. And that's only if they show profit. And realistically, these corporations, probably 90% of them zero out. We're just using them to get as much tax benefit and to oversee management and to create again, I use the term family office, but a structure of your investments for estate planning. So we can have our kids, for example, start learning this by being on the board without owning the asset. So we can try, using a kind of a fake it till you make it component. You start having board meetings, you start talking about your family finances. It's kind of magic what that does with folks. It really makes a big impact. Stanley says, can I trade in 2 separate IRAs, one Roth, one in regular? Yeah, of course. You can go crazy in them. Does the Corporate Transparency Act impact the protection you get from a small business entity? Ray, it does not. Again, that Corporate Transparency Act's been around in a different methodology in the Bank Secrecy Act. It's the same information, same database. They're actually both on FinCEN, and it's been there since 2016. So I think that they've been reporting. I think it's more than that. And then worldwide, this activity, this information has been collected by the European countries for many years. And so I talked to my colleagues. Anderson's part of a global company. We have offices in Switzerland, France, and Cayman Islands and Dubai. So I talked to my colleagues over there, and they're like, hey, we've been dealing with this stuff for years. You guys in America got it easy. They were like, it took you long enough for them to do the corporate transparency because money laundering is an issue. And it's the only way you can track them. Please touch again on how we create the anonymity by creating LLC Corp. We could still see founder and officer names. Please elaborate. Pavlin, when we set these up, the only information we have to provide to the state of Nevada is the organizer, which is us. So it'll be Anderson. Your name will be nowhere on these things from a public record standpoint. And that's how that works. Is a traditional IRA trading allowed in an LLC? You don't need it. So if you're trading in an IRA, don't worry, you don't need the LLC structure. Yes, an IRA can own an LLC. We call them checkbook LLCs if it's going to buy real estate and things like that, but not for trading. You don't need to. You can open up directly in that IRA, and you're good. So does Anderson act as my registered agent? Yes, we are a registered agent in 50 states. And we can handle everything from your bookkeeping to the tax prep to setting up the entities. That's what we do. And I think that means we are about at that time. So hopefully I answered your questions. How are IRAs protected? There's another good one. It's by state law. So some states protect them. Some states don't give them as much protection. For the most part, my experience is that people don't really go after the IRAs unless you've done something pretty bad. And in that case, what I would do is roll it into a 401k and make sure that there's somebody else participating in that 401k. And then you get ERISA protections. And the best example of ERISA protections I can give you is O.J. Simpson's NFL player pension, which he has a $30+ million judgment against him and they can't touch. So if you're ever in a situation where you're in a knockdown, drag out suit, there's still some things we can do. But step number one is make sure it's not in your name. All right. So that's about it, guys. Really enjoyed coming in. Sorry for the little delay. I'm not the greatest with technology. I'll be the first to admit it. No, it's just got locked out somehow. But I hope that you gain something from this, and reach out, please. It says it's a free link. It is a free link. We've been working with you guys in Simpler for years. We enjoy working with traders and anybody that's trying to better themselves. So anything we can do to help, we just try to be as transparent. Like, here's your options, A, B, C. That's what we're going to be looking at, is opening your eyes. So thanks again. And yeah, hopefully we get to do this again sometime.